Welcome back to the deep dive. Today, our mission is to analytically decode exactly how recent U.S. Treasury interventions and, well, this massive wave of global regulations are dictating digital asset valuations.
Right.
We're really trying to cut through the noise today to understand what's actually driving this market.
And there is a lot of noise right now. I mean, especially with Bitcoin just blowing past $79,000.
Yeah.
But if you look at the actual mechanics behind it, the catalyst didn't even start in the crypto markets.
No, it started in the bond market
Mm-hmm.
with Treasury Secretary Scott Bessent.
Exactly.
The Treasury stepped in and increased their long-dated bond buybacks to over $4 billion per operation, which is huge.
It is, and that's the domino that really started this whole chain reaction.
Mm-hmm.
Because when the Treasury buys back bonds, they're essentially injecting this massive amount of cash into the financial system.
Right.
And investors take that cash and immediately look for yield somewhere else. So that sudden influx compressed bond yields, and naturally, it weakened the U.S. dollar.
Yeah, the U.S. dollar index dropped to, 98.8?
Yep, 98.80.
And when the dollar weakens like that, capital just flees to hard, scarce assets. I mean, we saw gold push past $4,515 an ounce, but Bitcoin didn't just catch a bid, it absolutely launched.
Right, because it hit a wall of offshore derivative shorts. For months, traders were just comfortably building these really heavy short positions while the market was consolidating. They were betting the price would, stay flat or drop.
Okay, let's unpack this for a second. Because the way I visualize this violence of a move, it's like the Treasury's bond market intervention was basically throwing a match onto a powder keg.
Yeah, that's a good way to put it.
Or, a powder keg of concentrated short positions, right? And when Bitcoin breached that $72,000 level, boom.
Boom. Auto deleveraging.
Yeah.
It just forcefully liquidated almost $747.7 million in short positions.
Yeah.
It pushed the BVIV volatility index right past 40. Yeah, it's algorithmic forced buying. But what's really critical here is analyzing why buyer demand across both the spot and perpetual markets finally registered positive.
Right.
For the first time since October 2025, it wasn't just a temporary squeeze. It transitioned into actual sustained market demand.
And that transition is exactly where Wall Street comes in, right?
Yeah.
Because the short squeeze provided the sudden upward violence, but institutional capital is pouring the concrete floor beneath these new price levels.
Exactly.
I mean, spot Bitcoin ETFs absorbed over $606.3 million in a single session.
Which is staggering.
It is, with BlackRock taking $503 million of that alone. So U.S. funds now hold 6.08% of the total circulating supply. And Ethereum ETFs also hit a 2026 high of $220.8 million.
Yeah, which fundamentally alters the supply dynamic.
Well, wait, here's where it gets really interesting, and I want to challenge you on this.
Okay.
We see these massive ETF inflow numbers, but is this actually new demand? Or is this just traditional finance repackaging existing crypto capital?
What do you mean?
Are these new buyers or just, a guy selling his old exchange stack to buy a BlackRock wrapper for his 401k?
I see. Well, it's a completely fair question. But the math behind circulating supply absorption tells us that the source of the funds actually matters less than where the coins end up.
Okay.
Because these funds are locking up over 6% of all Bitcoin in existence. Even if it is just capital rotating, the sheer volume of spot Bitcoin being removed from liquid tradable exchanges, it creates a massive supply shock.
All right.
You're seeing structural scarcity happen in real time.
And we're seeing those altcoin ripples, too, reacting to these microcatalysts. HYPE gained 25% just on a potential CFTC compliance pathway.
Yeah.
And Layer 0 digested a 32.6 million token unlock. Normally, that floods the market and crashes the price, but it just absorbed it.
Right. It shows incredible underlying appetite. But, while Wall Street buys up the supply, Washington and global tax authorities are rapidly building these high-security fences around the whole ecosystem.
Oh, the regulatory squeeze, it's everywhere all at once.
It really is.
In the U.S., the Clarity Act faces a critical September 15th Senate vote, and it's totally deadlocked right now over lawmaker ethics and state banking sovereignty.
Yeah. And meanwhile, the UK's HMRC just fired off 81,172 tax warnings.
81,000.
Well, they're prepping for the 2027 OECD reporting framework. And then you've got OFAC sanctioning the Sinbad.io mixer for laundering North Korean funds.
Not to mention Coinbase facing that investor lawsuit over their bankruptcy disclosures.
Right.
So what does this all mean? Like, is this aggressive global compliance dragnet simply the unavoidable tax or institutional adoption?
I think so, yes. It's a clear pattern. Governments are simultaneously integrating and restricting digital assets. They want the ETFs to absorb capital into the traditional system, but they are systematically choking out the privacy layers.
They want the asset, but strictly on their terms.
Exactly.
So the takeaway for listeners is that institutionalization brings price appreciation, definitely, but it demands rigorous compliance and security vigilance. I mean, look at the recent firmware vulnerabilities in Cold Card and Bitbox hardware wallets. You're defending against nation-state hackers now.
The asset is maturing, and that maturity demands institutional-grade architecture.
Which leaves us with this final provocative thought. With Wall Street funds swallowing 6% of the supply and international tax agencies automating transaction tracking by 2027, is the original cypherpunk vision of an untraceable outside-the-system currency functionally dead?